NeuralTarot. Today, we're going to pull back the curtain on one of the most powerful yet invisible forces in our financial world. It's not about the daily news or company earnings. No, it's something much, much deeper. A hidden current that really dictates the entire rhythm of the market. So let's dive in.
Here's the journey we're going on. We're going to start with something we all recognize, the price chart illusion. Then, we'll peel back that layer to reveal the unseen force of liquidity. We'll look at what happens when the market is flowing smoothly, and then what happens when it all just stops. Finally, we'll put it all together and learn how to read the deeper pattern that's hiding right there in plain sight.
All right, part 1, the price chart illusion. You've seen it, right? One day, everything seems to just glide along peacefully, and the next, it's absolute chaos. So what is really going on behind that screen?
Every single day, we see these charts, those jagged lines dancing up and down. For most of us, this is our main window into the market. But really, it's just the surface. The real question we need to ask is, what forces are actually pushing and pulling those prices around?
Well, to try and make sense of it all, people usually grab one of two toolkits. On one side, you have fundamental analysis. This is all about digging deep into a company's financials, the economy, trying to figure out its true value. And on the other side, technical analysis. These folks ignore all that and just focus on the chart itself, the past prices, the volume, believing that patterns and human psychology tend to repeat themselves.
But here's a critical thought. What if both of these approaches are just describing shadows on a cave wall? What if they aren't the cause of the market's moves at all, but just reflections of a much more fundamental, hidden mechanism that's really running the show?
And that brings us to the core of it all in Section 2, liquidity, the unseen force. You can really think of this as the market's hidden operating system. It's the software running in the background that makes everything else possible.
So, what we see, that price chart, is really just a flat, two-dimensional record of things that have already happened. But what actually matters is the three-dimensional depth beneath that surface, and that's market liquidity. It's the hidden environment where all the trading actually happens.
So what is it exactly? Well, simply put, market liquidity is the market's ability to soak up big buy and sell orders without the price going completely haywire. It's really just a measure of how smooth and stable things are. And here's a really great way to picture it. Imagine a deep harbor. That represents high liquidity. A massive container ship, that's like a huge trade, can sail in and out and it barely makes a ripple. Now picture a shallow harbor. That's low liquidity. In that environment, even a tiny little boat can create huge, disruptive waves.
Okay, so let's talk about what that deep, healthy harbor actually looks like in practice. This is what we call a market that flows.
A liquid market really has three key signs. First, there are tons of buyers and sellers all ready to trade at a moment's notice. Second, all that activity leads to what we call tight bid-ask spreads. Just think of that as the tiny gap between the highest price someone is willing to buy for and the lowest price someone is willing to sell for. When that gap is small, it's cheap and easy to trade. And third, all this creates orderly price action, where even big trades get absorbed without a fuss.
So you might be wondering, where does all this stability come from? Well, a huge amount of this depth is provided by large institutional players. Think pension funds, big banks, market makers. They're the ones constantly buying and selling, and that's what keeps the harbor deep and the waters calm for everyone else.
Which, of course, brings us to a much more dramatic question. What happens when the flow stops? What happens when all of that water suddenly vanishes from the harbor? Behavioral finance research describes this moment perfectly. It talks about these periods of wild price swings and this phrase, liquidity evaporations. It's like the market just dries up. Suddenly, everything becomes chaotic, and all the classical theories about how things should work just go right out the window. And this shows you what that looks like in the real world. That bid-ask spread, the cost of trading, it jumped from a tiny 0.10% in a normal period to 0.80% during the 2020 crash. I mean, that's an 800% increase. The harbor didn't just get a little shallower. It practically turned into a desert, making every single transaction incredibly expensive and disruptive. So how is that even possible? How can something that feels so deep and stable just disappear, almost overnight? Where does all that liquidity go? Well, the answer is something called a behavioral cascade. It's this chain reaction of human and machine psychology. It kicks off with herd behavior. Fear spreads, and suddenly everyone is rushing for the same small exit.
That gets worse with a flight to liquidity, where people don't sell what they want to sell, they sell what they can sell. Then you have loss aversion kicking in, that psychological pain of loss that is so much more powerful than the pleasure of gain, which just fuels the panic. And for the final blow, all those automated trading systems that provide so much liquidity, they're programmed to just go offline during chaos, vanishing at the exact moment they're needed most.
And this is the result. The market transforms from that deep, flowing river into a bunch of shallow, disconnected puddles. In that kind of environment, even a small trade, that tiny boat from our analogy, can cause a tidal wave. And that's where you get the extreme, gut-wrenching volatility we see during a crash.
All right, let's tie all of this together in our final section. It's time to start reading the deeper pattern. This is really about learning to see the market not as a simple line on a chart, but as a dynamic landscape of liquidity.
So here it is, the most crucial insight. That price chart you see on your screen, it's not just reacting to news or fundamentals. More often than not, it's a direct map of the hidden landscape of liquidity underneath. The price isn't the whole story, it's just the signal telling you how deep the water is.
It's really that simple. When you see a calm, orderly market, what you're actually seeing is the effect of deep, abundant liquidity. And when you see a chaotic, volatile market, you're seeing the effect of a shallow, fragile, and evaporated pool of liquidity. This is the unseen pattern. This is the hidden structure that's really guiding the market's behavior.
And that leaves us with one final thought to ponder. If the price chart is just the shadow on the wall, and liquidity is the hidden object casting it, what other unseen forces are out there quietly shaping the world we think we see every day? That's something to think about. Thanks for joining us as we continue to decode the unseen patterns of the world. Remember to subscribe to NeuralTarot for more.